Hello, YouTubers. Greetings. Thanks for tuning in. I've got a fantastic case study that I thought you'd be interested in. Specifically, this is on a retiree who had called me out of California, and they have $2 million of monies in a tax deferred account in their IRA account, and another $1 million in a non-qualified account, just a regular brokerage account. Retired, 65 years old, and they like many of you, they knew that they had a tax problem, and so they wanted me to run the numbers from a tax plan on how they could reduce their tax liability, or if they should even do a Roth conversion and kind of what that looks like. So our study today is how to reduce taxes on a $2 million lump sum Roth IRA conversion. So it's the difference between paying $1 million in taxes and $250,000 in taxes. So let me give you some more details about this case study and kind of how it works. Um, Again, this couple, when they elect Social Security at full retirement age, they're going to be getting about $88,000 a year just from their Social Security benefits. They're in a situation where all of their debts are paid off, and so if they do it the right way, they can live on their Social Security. Now they have another $1 million in some non-IRA assets. Their portfolio mix is pretty conservative, just a typical 60-40 mix, 60% large cap stock and 40% corporate bonds. So that's kicking off the income that they need. They don't have a pension. They only need about $60,000 a year of inflation adjusted income. So with a $3 million nest egg, I mean, that only represents a 2% cash flow. So currently today with interest rates over 5%, they know that they're okay on being able to go through and do that. And they knew that they would have a tax liability if they didn't do Roth conversions. So I ran the numbers for them, and check this out, okay? On this lifetime tax liability on their current plan, if they don't do Roth conversions, look at this tax liability. $9 million roughly is their tax liability if the wife lives to age 100 and the husband lives to age 90. I mean, look at this. So when they, for these initial years, $400 in taxes, $3,000 in taxes, $6,000 in taxes. This is when their Social Security is just starting to kick in. But notice what happens here when they get down at age 72, 73. This is when those first required minimum distributions kick in. So they've got an increase of $50,000 a year in their tax liability. So it's $76,000 in 2031, $85,000 in 2024. Let's run down the list here. Happy birthday. You're 80 years old, $153,000 in taxes. And when you run down the gamut here, husband passes away, wife is now paying a single widowed taxpayer rate. Congratulations, $400,000 a year is her tax liability. So again, people say that these numbers are just crazy high, but the math doesn't lie. If you're in a situation in retirement where you can live off of your pension income or your Social Security income, or off of your dividend and interest income, and you don't really need the income from your IRA account or your 401k account, those required minimum distributions are detrimental. So if they wanted to just simply do a lump sum conversion, it's $1 million. It's $1 million all up front. Now, granted, that greatly reduces their tax liability, but they're obviously hesitant about doing this because if they take $1 million out of their portfolio, that's going to wipe out their non-qualified brokerage account. And that's what they're using as kind of their slush fund to pay for other expenses that they're going to have. If they do what most planners recommend, which is filling up your marginal tax bracket, if you're trying to do some type of a Roth conversion, look at what they've got here. So they're almost ready to pull the trigger on this, and this is when they called me because they said, Dave, look, over the next 10 years, we're going to be spending well over $1 million anyways on filling up our 24% tax bracket. Granted, our lifetime tax liability has decreased by $6 million, so they're only paying $3 million in their lifetime tax liability versus the $9 million. But they're still spending over $1 million over the next 10, 11 years. So enter the supercharged Roth IRA conversion strategy. We've talked about this in other videos, okay? Now, their annual tax liability is still around $3 million, dollars, and this is on a level one proposal. Reason being is they still have a significant amount of their non-qualified $1 million brokerage account that's kicking off interest and income for them all throughout their retirement life. So the kicker is, instead of dropping $1 million in year one to do a lump sum $2 million conversion, or $1 million over the next 10 years, they're able to do a supercharged conversion and only spend $250,000 in taxes on a 1 year conversion. And people say, Dave, how is that possible? How does that happen? Well, it happens by understanding the dynamics of the tax code, and what are some of the unique techniques that you can use to reduce that tax liability. So here's a mock 1040 form. Again, on line 4, we're taking a $2 million lump sum distribution out of their IRA account. This is what we're recommending. So again, if we look at this on line 4, $4 million IRA distribution right here, or excuse me, $2 million Roth IRA distribution. So you've got your total income here in line 9 is $2 million bucks. But notice what we've got here in line 10. We've got this adjustment of over $1.2 million of monies where we're able to reduce their taxable income and get their adjusted gross income down to $1 million. So people say, Dave, how are you able to reduce my taxable income from $2.2 million down to $1 million? Well, this is understanding some of the unique dynamics and some of the unique provisions of the 2017 Jobs Act and the 2022 Inflation Reduction Act. There are buco tax credits and tax deductions that you can use. In this case, also, they're able to get this nice itemized deduction of $300,000. So this reduces their taxable income again down from $2.2 million down to $700,000, giving them a total federal tax due in this case of $189,000. Understanding what happens with the tax code, and specifically how you can use these supercharged Roth IRA deduction formulas that are out there from the Jobs Act and the Inflation Reduction Act, are key for this couple in making a significant difference in their tax liability. Look what would happen if they didn't do that. Okay, let's fast forward. Let's fast forward under the current plan. Let's look at what their Social Security would be in 2030. So we look forward at 2030, they're getting $99,000 of Social Security benefits. Again, they're in the upper tier of wage earners. They're able to do this. $84,000 of that is included in their taxable income because they haven't done proper planning. Look at what they've got with their IRA distributions. With their IRA distributions on this. On their IRA distributions on this that they've got, it's a significant amount of monies that are coming out that they have to pay taxes on. Here in this case, let's see here. So for the required minimum distribution, again, at 73, or in 2030 at age 72, it's $22,000. That's their annual tax liability. In 2031, that first required minimum distribution kicks in. It jumps up to $76,000. So if we scroll down here and look at what that tax liability is going to be when they have that first required minimum distribution, it's $143,000. Again, problematic in the sense of it doesn't have to be that way if they do proper planning. So these are some questions that every retiree should ask themselves. Number one, what is your current lifetime tax liability? If you have over $1 million of monies in a tax deferred account, whether it's a 401k or an IRA account or whatever the case is, you need to calculate what your tax liability is going to be over the next 5, 10, and 15 years. And here at Optimal Tax, we can do that. How much will you lose in unnecessary fees, expenses, and taxes and penalties? What are your Medicare and Social Security means testing penalties going to be? So here we can calculate the numbers on that with our tax planning tools. This graph here shows the Medicare premium amounts that you're going to have to pay. And again, the amount that you pay for your Medicare is based on your modified adjusted gross income. So these lines here show the amount of additional Medicare premiums that you'd have to pay. So for this couple, in blue is their income, and this is when the required minimum distributions kick in. So notice that what happens on that. Their modified adjusted gross income here, they're spending anywhere from $400 to over $500 in the future each, because they haven't done proper tax planning and they're being dinged for additional Medicare premiums, almost 5 times the amount of what the typical retiree would have to pay. It's not like they're getting 5 times the care, but this is what they're subject to because they haven't done proper. Number 2, can a regular Roth IRA conversion lower your overall tax liability? You need to run the numbers and look at what your break-even point is. If you go under the traditional scenario of filling up the marginal brackets, how long is it going to take you to do that? How much are you going to have to pay in taxes? And when you got to break even? Again, most people don't want to write that check for $1 million early on in retirement because they're worried about what's going to happen later on down the road. Number 3, how can a supercharged comprehensive Roth IRA conversion benefit you? Specifically, how can it help you immediately save monies on your taxes now and over the next 5, 10, or 15 years? So again, in this scenario, this is saving them over $6 million in taxes in their lifetime. But compared to a lump sum conversion, it's saving them $750,000. So the key is the 2017 Jobs Act and the 2022 Inflation Reduction Act. This is how we're able to get that reduction of ordinary income and the $300,000 itemized deductions. Okay. There's a lot of chatter. I've had other videos about this, about the ability for a multimillionaire to go on and do a backdoor Roth IRA conversion. That could be changing in the future. Wall Street Journal had an article on this a year or two ago, said, quote, IRAs were designed to provide retirement security to middle-class families, not allow mega millionaires and billionaires to avoid paying taxes. Now, again, with a net worth of $3 million, these folks certainly didn't consider themselves mega millionaires and mega billionaires. But by not doing a Roth conversion and exposing themselves to $9 million in lifetime taxes, it causes a big problem. So when you start adding these things together about what the benefit is that they can do, when you look at doing a proactive Roth conversion, not dropping $1 million in taxes, looking at doing a year 1 conversion, using these provisions from the Jobs Act and the Inflation Reduction Act, the compound effect on their net worth is staggering. And that's what we show here, an ending value of $85 million of their net worth versus $25 million. Again, for these folks, they're smart. They realize that they've got a tax problem. They also realize that they've been blessed because they're not in a situation where they need a large drawdown from their portfolio. So having an ending value of $25 million is going to be just fine, but they didn't work their whole life to give $9 million of money to the government. They would rather those monies go to their kids and grandkids and so on and so forth. So proper planning, looking at that, not only reduces their lifetime tax liability by $6 million, but it potentially increases their net worth by over $60 million to $85 million. If you'd like to get more information about this, we'd love to sit down and run through the numbers and share with you how we've been doing this and how we've been helping clients for years go through and implement these supercharged Roth IRA conversion strategies. One of the cool kickers of this program that we've got right now, and people ask, is they say, Dave, how am I going to pay the taxes if I do what you're recommending and do a lump sum conversion? Well, we can show you options here on number 4. Can you use supercharged Roth IRA techniques to pay your taxes without reducing the principal balance in your brokerage accounts or your Roth IRA accounts? Yes, there are ways that you can go through and do that. And people say, Dave, hold on just a second. You're saying there's ways. that I can use my Roth IRA to pay the taxes, in this case $200,000 in taxes, without reducing the principal? Well, how exactly does that work? Again, if that merits a phone call, get on my calendar. You can click on the link below. We'll go through a quick 15-minute review about how it works, how the tools function. Thanks again for watching the video. Like and subscribe. Take care and have a good day.